Hi, this is Dan Collins, editor-in-chief of Modern Trader magazine, coming to you live from the floor of CME Group on December 30th, basically the last full trading day of 2015 for Traders Exclusive. As we end this year, just wanted to do kind of a wrap-up on things and saw some disturbing story yesterday. It was a market story touting 2016 as possibly a strong year. And not a very controversial article. Basically made the point that, the recession maybe we're waiting on has happened in Europe and it's over and there's better things to look forward for equities in 2016. Not making a prediction here, but it was interesting because there was reams and reams of comments following the article, and it mostly surrounded political items. And it's something that 2015 has already been a very political year. 2016 is an election year, and unfortunately in the business media that has kind of crossed over, so people's analysis is more on their political perspective often on the current administration, who they want the next administration to be. You can like whoever you want. It's true that we've had a tremendous bull market in equities in a long 5-year recovery that hasn't really felt like a recovery, and that has a lot to do with it. But often the analysis of the markets is skewed by people's perspective, by their political views, and that's very dangerous for traders. You can like the current administration, not like the current administration. You can think we're on the right path, on the wrong path. But be careful of people who try and skew numbers. Right now, let's talk about unemployment. It's at a very low 5%. There's been a claim made that that's not real. Well, I would say it is real. One point we know is that the numbers are still done the same way. John Williams, who has a website called Shadow Stats, has put out what the numbers are based on how the government has skewed those numbers to present happier numbers. But those skews happened decades ago. So it's the same numbers comparing to the last 10, 20 years. So we have to be careful. Is the participation rate down? Yes. But if you look at what the Fed says, most of that is due to demographics and the fact that baby boomers are retiring. It's certainly a part of it. And now I'm not trying to make an argument that things are great, but often these arguments you're seeing are political arguments, and they're fine, but you can believe a certain way. Most of the economic activity is cyclical and probably doesn't, whoever's in power at the time gets too much credit and too much blame. But the point is, make sure the analysis that you're reading is true analysis and not someone putting their political views out there, because it'll affect how you trade, and that could be be harmful to your bottom line. Now quickly, I want to talk on interest rates, because after 6 years of a zero, more than 6 years, 7 years of a zero interest rate policy, Fed is easing. Most analysts will acknowledge that a lot of the bull market has to do with the zero interest rate policy and endless QE, which ended just over a year ago, and basically was with interest rates at zero, money had to go into the equity markets, because that's where you're going to put risk assets, because there was no yield anywhere else. Well, we began a tightening cycle earlier this month with the first rate increase. Depending on if you're looking at the market or if you're looking at the Fed forward comments and their dot plot, it'll go up another 50 to 100 basis points in 2016. That's only 50 to 100 basis points. So right now, the target Fed funds rate is 37.5 basis points. In the most, the highest scenario, it'll be 1.5 by the end of 2016. That's still extremely low, and that's still going to put, that's still going to benefit equities, because you're still not getting yield anywhere else. So that trend that we saw, that support for equities by these very low interest rates will still be there to a lesser extent. So the idea that, okay, we started a tightening cycle, now equities aren't going to be supported, so we go down, it could go down. We've had a long bull market. We had 10% correction, over the last several years, 2, depending on how you do the numbers. So people expect a downturn. That still could happen, but the support embedded in this very low interest rate environment is still there for equities, even if it's a little bit less so. Hoping everyone has a wonderful and healthy 2016. This has been Dan Collins, Editor-in-Chief of Modern Trader Magazine. Before I leave, I have one more thing to say. Look for our February issue that was mailed out. Some of you may have it. We'll be getting it in the next couple of days. We provide our 2016 outlook, and we also do a strong and serious analysis of how markets are forecast. It's very important because we're coming up on an election year, and some forecasts are entertaining. It's important that you can trust the people you're looking for, and you trust the information that you're getting, and hopefully this will help you do it. Once again, Dan Collins, Editor-in-Chief of Modern Trader for Traders Exclusive. Everyone have a great 2016.